Welcome to It Depends, a sales tax podcast by TaxConnex. I'm your host, Brian Greer. Sales and use tax can be confusing and very overwhelming, but it doesn't have to be. Whether you work in industry or at a CPA firm, or just someone who wants to stay informed about the latest sales tax laws, we've got you covered. Periodically, we'll explore different aspects of sales tax. So whether you're a tax pro or a novice, tune in and join us as we attempt to simplify the complexity of the sales tax world. This is It Depends, because with sales tax, there's rarely just one answer, and often that's our answer to many questions. It just depends. But just to provide you a little bit of perspective on the agenda, we're going to talk about, what really makes an organization complex for sales tax purposes. Sometimes, we work with e-commerce companies that are selling tangible personal property to consumers. And while it can be burdensome and overwhelming to manage sales tax in that environment in 10, 20, 30, 40 states or more, it's not necessarily complex. So we'll define what that complexity means. We'll talk about some industries that tend to be a little bit more complex than others, at least for sales tax purposes. And then the last three bullet points there, somewhat of the answer, I guess, in terms of certain things or certain factors that make an organization complex. We'll talk about those specifically in terms of selling through multiple channels. Drop shipments are always a fun discussion. And then also if you're selling to exempt customers, what that does from a complexity perspective for you. Perfect. And Jeff, I think I'll turn this part of the discussion over to you.
How do we define a complex organization from the standpoint of sales and use taxes? The first thing we think of, and it's interesting that there was a tie on the nexus and taxability side. In fact, I'll have a comment on that as I wrap this slide up, but a diverse set of products and services, that's typically the most challenging. But it's a combination of things. So it's not just a diverse set of products and services. It's that combined with some of these other factors. Selling to exempt customers, a large geographic footprint, meaning you're operating either physically in a lot of states or at least your customer base is fairly spread out over a lot of states. Multiple locations, physical locations, whether that be an inventory, warehouse situation, or a physical office, and then selling through multiple channels. What's nice, and we'll talk about all of these in a little bit more detail as we progress this but the thing about selling through multiple channels is some of the recent laws and changes around Nexus have actually benefited companies that do sell through multiple channels and given them a little bit of at least perceived relief. And we'll talk about that in just a moment. There's going to be a group of companies that their product base may not be as diverse. In other words, they're doing providing a primary service or selling a primary product or set of products. And so their challenge is, where and when do I have nexus? Where and when do I have an obligation to comply for sales and use tax purposes? And not just that the rules are changing, which they do change, by the way, and so it's a valid point, but sort of the dynamics of businesses change and the way they deliver their products and solutions can change year over year. And so their nexus footprint can be an evolving concept. And then the second one being the complexity of taxability. Those would apply to companies that, as you can define, they have a lot of products and services. They have a lot of diversity in what they deliver and what they provide to their customer base. So I use the term convenience store. The convenience store, your local convenience store, is one of the most complex environments when it comes to retail sales activity that you'll ever find. Because if it's a fairly large convenience store, you've got everything from soft drinks to medicines to cigarettes to prepaid phone cards to hats, I mean, it really is. And then all the different food products, candy, food that you take home and prepare. It's really a thing. So those people that are finding themselves in the convenience store element of that, they're going to answer that question right down that line of the taxability complexity. Brian, I think when we think about the complexities as we've kind of defined them here, the industry segments that kind of correspond to that complexity are listed here. And telecommunications is the first one intentionally, and it is the most taxed and regulated industry, in our opinion, across all the states. And the complexities within that business model, the way communication services are delivered today, it's ever changing with technology, and the scope of what telecommunications is defined as has changed a little bit over time as well. Second to that would be hospitality. This is restaurants, hotels. A lot of, and most of us are familiar with this, a lot of times there's very discrete tax types that are imposed on hospitality, meaning there's city level or even district level taxes that apply to a specific hospitality service, whether it be a restaurant, a bar, or a hotel type atmosphere. Healthcare. Healthcare is complex just because there are so many variables in the delivery of healthcare, and legislatures have been always sensitive to trying to recognize some of the things that are truly needs in the healthcare industry. As a result, you get a broad set of exemptions, things that are identified statutorily as being exempt, but would otherwise be taxable. Some examples, prosthetic devices, those are tangible personal property. Generally, if you walked into a store and bought a cane, you'd probably pay tax on it, not necessarily in all states. But if I had a prosthetic leg or limb put on me, a lot of states will provide an exemption for that because of its pure necessity and need. And there's just so many examples across the healthcare industry. We've done a good bit of work in that area and probably only scraped the surface, because you go anywhere from MRI machines down to blood coagulators and syringes and things of that nature. There's all kinds of different treatments that can fall into an exempt category or a special tax treatment. Manufacturing, which involves processing, and we've kind of lumped mining. And when we say mining, we're talking drilling and mining together. These are another area of complexity, primarily because these create jobs, and the state government recognizes that if we give incentives for companies to move their manufacturing facilities here, or we look at how we're going to regulate mining, there's a lot of special tax treatment that goes along with that. So there's a lot of exemptions for manufacturing equipment as well as for processing and mining activities. You get into Texas, for example, and I'm thinking of gasoline processing or oil processing. Those major, huge, massive, Exxons of the world, they're operating in a different way than most companies operate. And the state affords them some degree of flexibility by allowing them to have what we refer to as direct pay permits. But it brings just, again, a level of complexity. And the more states you're operating in any of these categories, the more significant that's going to become. Technology is interesting because I think it reverts back to that first polling question, the nexus thing. And historically, technology companies have been insulated from nexus. And we'll talk more about why that is in the next couple of slides here. But in essence, technology businesses that have operated, let's say, in California for their entire life cycle up until the last 5 years, let's say, they've been insulated. California generally gives preferential treatment to software applications. In other words, they're not taxable. But as soon as the Wayfair decision happened, technology businesses found themselves with nexus abroad throughout the country. Because it became an economic or a revenue-based threshold. And they were in for a rude awakening, and some of them are still in for a rude awakening as they get themselves acclimated or at least get educated on the existence of economic nexus. Lastly, we go back to the beginning, brick and mortar retailers. Why would we have that on here? It's a complex thing when that's sort of the baseline of what we think of when we think of commerce. Well, the challenge can be situsing for brick and mortar companies. And I say that, I'll give you a little bit of an example. In some states, if you're selling to a customer who lives 3 counties over, and that county tax is different than the brick and mortar location. In some states, if I'm delivering to that customer, I need to be able to charge that destination tax rate, the county rate where that customer resides. This can happen in an interstate fashion as well. Customers asking me to ship it across state lines. I need to be able to differentiate between whether or not that product is taxable in my home state, or where the location of the sale took place, or the destination state where the customer is necessarily taking possession. So there can be a good bit of complexity there. And even more so for location-based filers, companies that have a lot of locations when it comes to retail spots. A number of states will require you to have a registration for each location. And while it might be consolidated on a specific return for sales tax purposes, you actually have to segregate your data between each of the locations. So there's challenges that are presented to virtually any of us that are operating in an environment where we may have a sales tax obligation. But I think we look at these as being some of the more complex. So let's talk about Nexus. That's sort of the big change that impacted just about everybody. Traditionally and historically, Nexus for sales and use tax purposes was predicated on having a physical presence in a state. And let me just back up a little bit and make sure, I think I talked about this already, but Nexus is simply a connection. It's just, you can replace the word Nexus with sales and use tax connection, or you could say sales and use tax obligation. And basically when we're thinking about Nexus, we're trying to determine whether or not we have an obligation to comply with the sales and use tax laws of that jurisdiction. Typically, we think about it at a state level, but there are some local implications as well. And as I was saying, historically, if you go back 40, 50 years, we were basing all of our Nexus determinations on some degree of physical presence. Obviously, if I've got a brick and mortar store, I've got a physical presence. Obviously, if I've got a set of inventory located in that state, I've got a physical presence. What about an employee that's working from their home? That typically is going to trigger Nexus. What if I'm attending trade shows periodically within the state? That can trigger Nexus depending on the frequency. What if I've got employees or maybe independent agents visiting or entering the state to solicit on my behalf? There's rules around that have to do with frequency and the scope of their selling activities. A little less common, but somewhat surprising to folks is independent contractors performing services. So if you've got a business model where you aren't otherwise physically in the state, but for the fact that you engage local independent contractors to perform services on your behalf for your customer, you're essentially establishing a physical presence. You're leveraging in-state resources to be able to establish a market for your products and services. So those all can be examples of physical presence and physical nexus. What happened, and this was sort of a shockwave, so to speak, within the sales and use tax world. But what happened in 2018 was, as a result of South Dakota legislation, the U.S. Supreme Court got involved and handed down a ruling in favor of what we call an economic nexus theory or economic nexus law. Essentially, that constitutes a revenue aspect of business. So instead of it being physically or a physical presence test, it became an economic test. How much revenue am I generating from that state? In addition to that, there are transaction thresholds that were legislated in a number of states. So you had these states come out and say, look, we believe the marketplace has changed, the economy has changed, and this physical presence standard is antiquated, and it's time to reset. And that's what the U.S. Supreme Court ruled in favor of. It was a 5-4 decision, but it opened the door and released the legislation across all the states. Every state today has an economic nexus standard. This typical standard for economic nexus is $100,000 per year. So if you've had $100,000 in gross receipts in a given state, whether it be services or shipments of tangible personal property, you should probably ask the question, have I triggered economic nexus there? Now, there's other variables, and the thresholds vary between the states. They're not all gross receipts. Some of them are taxable receipts. They're not all inclusive of services. Some of them are just shipments of tangible personal property. They're not all $100,000. Some of them are $250,000. Some of them are $500,000. The general concept is, and the way I want you to think about it if you haven't thought about it before, is if you've had $100,000 in gross receipts in the last calendar year or to date this current year, you should be asking the question, have I triggered nexus? And on our website, we've got a nexus analysis tool that can help make some of those determinations if you need it. The last thing I'll talk a little bit about is home rule cities. And what do I mean by home rule cities? These are cities within certain states that have enacted their own administration around sales tax. They have their own laws, their own legislation and rules and filing requirements. So they're kind of mini states within a state in that regard. And they didn't want to be left behind. So in those states that you see here on your list, and I would add Louisiana to that list, with all the parishes being home rule, you basically now have economic nexus standards even at these levels, these home rule city levels. And what most of them have done is simply piggybacked on the state. So, for example, in Colorado, if you've established economic nexus at the state level, you automatically have it at the home rule level to the extent that home rule participates in the statewide program. In Colorado, there happens to be about 73 home rules. All but 5 of them, I think, today participate in the economic nexus threshold theory. Alabama is very similar. Alaska, again, similar. What's interesting about Alaska is one of 5 states that do not impose a state level sales tax. It's Alaska, Delaware, New Hampshire, Montana, and Oregon. However, Alaska does have cities that administer their own sales tax. So those cities got together and decided, hey, we need to protect ourselves here. So they said, if you've got $100,000 in sales into the state of Alaska, you now have nexus within our city, and you have to comply at that level. So there's some complexity to this, and I think this probably illustrates why we have half of the audience saying, hey, these nexus rules are complicated. They are. There's a lot of variability. A lot of interpretation has to go into it. And as I've said already, if you've got nexus within a jurisdiction, you have an obligation to comply with their sales and use tax laws. I can tell you that there are some situations, some business models, and we're going to talk about one of them later on today, where even if you don't have nexus in the jurisdiction, meaning that jurisdiction has no no authority over you to require you to charge tax, you may still find yourself in a position where you still need to register for sales and use tax purposes. But don't be fooled by the fact that if you don't have nexus, literally either physically or economically, you still may have some circumstances and business activities which may require expansive registrations in more states.
Yeah, I was just going to add one thing before you jumped in here to this multi-channel selling piece. And I know we just kind of gave a pretty brief high-level overview from a nexus perspective, but I did want to touch upon the transaction volumes as well as a nexus factor. From a economic nexus perspective, we were kind of focusing, and I think rightfully so, on the $100,000 of revenue being the main determining factor, or at least where your radar should be alerted that you need to look at something if you've got $100,000 or more of sales into a state. But there are factors, including the number of individual invoices or transactions in the state. Interestingly, though, we are seeing a lot of states pull back from that. So a lot of the states were $100,000 or 200 transactions. And so it really is becoming more and more just that revenue standard. And a lot of states are moving away from the transaction standard, even though that does still play a factor in some of the states.
Yeah, that's a good point. Thank you. So multi-channel selling. What we really wanted to talk about is the variables or the impacts of being in one sort of primary channel or having multiple channels. Certainly, to the degree you're a multi-channel seller, it's going to add complexity to the business. But even within any of these sales channels, in and of themselves, there can be a great deal of complexity. And when we talk about channel sales, we're talking about whether or not you're making direct sales, which might be door-to-door sales, or you might have a brick and mortar location. Wholesale sales, which are happening in just about any of these channels, but there are characteristics of wholesale sales that drive complexities that don't exist necessarily for other companies or other types of industries. So we'll talk a little bit about those when we talk about drop shipments as well. Online sales, obviously, this is what spearheaded the Wayfair decision, and the target of the Wayfair decision, or the target of the legislation in South Dakota, was online sales and retailers that sell online, but there's a lot of wholesale activity online as well. And then lastly, marketplace facilitators. We'll talk about what a marketplace facilitator is in just a moment. But that concept and that facility has made it really everybody in the United States and the world, frankly, is capable of starting their own business tomorrow as a result of marketplace facilitators and becoming a lucrative business on top of that. But in any of these channels and in all of these channels, there has to be some consideration given to some of the things we've already talked about, Nexus primarily, but then that taxability, the determination of how the tax applies or whether it does apply to the products and services. Citicing, I used the example earlier of the brick and mortar retailer who was selling to a customer who lived 2 counties over and were delivering to their house. Citicing matters, and it can be really complicated when you get into technology businesses, especially in the cloud-based technologies. Tax calculation is really, it's not different than taxability, but it's one thing to know the taxability of your products. It's another thing to get it calculated correctly and on the invoice. And you've got to integrate a rate solution with that. There are about 12,000 different rates throughout the country because you have to consider both state and local. And there are tools that consolidate the taxability as well as the tax calculation into one. But so many companies, especially us focusing in the small to mid-sized market, so many of our clients are managing this more manually, and they're making taxability determinations. Maybe they've got a more homogeneous product line such that the taxability is not overly complicated, but at the same time, they're selling everywhere. And so their rates are complicated. And so they've got to be able to match the two up and be efficient and effective at it. And then lastly, exemption certificate management. We haven't really talked a lot about exemption certificates. We did talk a little bit about wholesale sales and some other type of customer types, but we're going to get into that here in just a couple of slides as well to kind of describe what we mean by exemption certificate management and why it's so critical.
And Jeff, just to add a thought here, one of the concepts with this multi-channel selling aspect is that for the most part, sales through all of these different channels will contribute to those economic nexus standards. So, if you're selling on an Amazon, for example, and as Jeff mentioned, we'll talk about the marketplace facilitators here next. But if you're selling on Amazon, the sales through that channel will, in most states, have a factor or a bearing on whether you have economic nexus for your other channels. So now you're selling on your own website. You may only have $10,000 of sales on your own website, but you have $100,000 going through Amazon. Well, now you have to charge tax, or you're responsible for the tax on those $10,000 of sales through your own website. So that's some of the complexity here that we wanted to point out, is that with these different channels, you got to look at it holistically, and they influence each other, and they influence how you need to respond to and manage sales tax. All right. So Jeff, this is the conclusion on multi-channel selling, but go ahead.
Yeah, just to drill down a little bit and describe marketplace facilitators and tell you why they're special. A marketplace facilitator, everybody knows them as Amazon or Etsy. Wayfair was a marketplace facilitator. These are platforms that allow third-party sellers to participate in marketing and selling their products. And the key factor that's important that differentiates a marketplace facilitator from just a marketing type firm is the fact that they collect payment. They process payments. So when you're talking about Shopify, for example, Shopify is not a marketplace facilitator because they don't process payments. You have to bolt on a payment processing system to that model. But in each of these examples we give here at Amazon, eBay, and Etsy, you can go online, purchase a product, and execute the payment and make the transaction complete. So that's the definition at a high level of a marketplace facilitator. What's interesting about marketplace facilitators, a couple of things, one of which Brian just kind of communicated. The states have, in addition to coming up with this remote seller, this economic nexus standard, applying to direct sellers, they also created laws for marketplace facilitators that are very similar. So if a marketplace facilitator has a certain threshold of gross receipts in a specific state, and they are required to comply with the sales and use tax laws, and they actually step into the role of the vendor. They are actually charging, collecting, and reporting and remitting the sales tax once they hit that threshold. So if you're selling through Amazon, Amazon's charging the tax on that transaction. And as Brian said, you do have to give some consideration. Some states require you to include these receipts in your gross receipts for calculating your nexus threshold. So just be mindful of that. You know, it's not unusual that we start talking to a company and they say, hey, 98% of our stuff goes through a marketplace facilitator. Very, very small percentage is going direct through our website. Well, the reality is the marketplace facilitator activity is what triggers the nexus, which then makes you liable on your internet sales, your direct website sales. They become taxable. They become, or at least subject to the rules and guidelines of those specific states in which you've met that threshold. So again, it's just another complexity, another layer of complexity that gets added to a business model in terms of managing through the sales tax environment.
And that not the drop shipment survey, but the economic nexus questionnaire survey guide that we had referenced earlier that's on our website, it'll have a notation as to whether the economic nexus standard is based on the gross sales or the retail sales or the taxable sales. So another important factor to take a look at as you're looking at that economic nexus guide.
A lot of times I'll be talking with a company and I get this question, what are the most aggressive states? What are the states that I need to worry about the most? And my common answer to that is the one that's knocking on your door at the moment. They don't matter until they knock on the door, until you're under audit. Does it really, they're not aggressive if you don't ever hear from them. And the challenge in all of that is if you're operating in a multi-state environment, you're selling into 10, 15, 20 states. I can tell you that you're not going to get audited by all of those states probably in your history of existence. You might get audited by 5 of them. You might get audited by 10 of them, depending on your size and the way you do business and the way your business name is exposed in the marketplace. You won't get audited by all of them, but it's compliance is like insurance. uh, you've got to assume you are going to get audited by all of them. You've got to operate as if you are going to get it audited, because the pain and the result, the negative result or the risk of not complying is so great that you just can't afford to ignore it. So it's an interesting dynamic. We have a client that had operated for close to 20 years and had never been audited. And we were really close with their CPA firm. Their CPA firm kept encouraging them to get compliant, to start complying. And lo and behold, one day Mississippi showed up at the door, started an audit, and our CPA friend called me up and he said, "Hey, Jeff, I need your help. My client's being audited. They've been operating forever. They're already looking at an assessment. Can you come in and help us out?" Well, we were able to mitigate that assessment. We were able to get it actually resolved, and no tax was due. So you might think, okay, well, no harm, no foul. That just proves the point. They shouldn't have been compliant. Well, after that experience, it made them nervous enough that they thought, let's make sure we're compliant where we need to be. And as a result of that, we did go through a compliance exercise. We got them registered in about 15 states, I think it was. About 6 years went by, and we were serving them, helping them with their compliance. 6 years later, they went to sell the business. And it was during a time, a few years ago when the markets were just crazy, giving crazy multiples. And it was a family-owned business, and they had an extraordinary result in the sale of their business. And the CPA firm that we had the relationship with that served them and worked with them through that acquisition, he came to me afterwards. He said, "Jeff, I wanted to share this with you." He said, as they went through due diligence, and on the backside of due diligence, they thanked me and said, "The best thing you ever did for us was recommend us to TaxConnex, because had we not been compliant, the level of due diligence that was exercised against our sales tax compliance was so significant that we were safe because we had already taken the necessary steps." So there is some reality to it, whether it's an audit with the state or whether you're in a business that might be looking to do something from an equity play. Somebody's going to look at it at some point. When they lift back the covers, it can feel a little uncomfortable. Sorry, that's just a sidebar. I didn't
No, that's
that as
good.
part of this presentation, but the importance thereof. So drop shipments, we talked about drop shipments briefly early on in the conversation. I think I was mentioning it when I said, hey, sometimes you might not even have nexus in a state, yet you still might need to get registered. Well, these are some examples that might sort of expose that reality. Generally speaking, and the best example we can show is that we have a three-party transaction where all three parties are in different states. They don't always have to be in different states, but for simplicity, we're going to say they're all three in different states for this example. We have a South Carolina, we'll call them a retailer. This is a company that has decided to go online and sell hats. And they don't make hats. They don't keep an inventory of hats. But they've figured the web, they've figured the World Wide Web out. They figured e-commerce out, and they decided, hey, I can be a specialist of this. I've got a good marketing background. I'm going to build a website that's going to influence people, and I'm going to sell unique hats. Then I go out, I put my website together, and I get a customer, and that customer is in Illinois. The customer in Illinois goes to my website and says, hey, I want to buy one of your hats. I say, okay, here's the transaction, pick the hat, give me the credit card. Now I got to fulfill that obligation. I'm buying a hat from somewhere and shipping it to that Illinois customer. Again, I don't keep an inventory. So I go to this distributor in Arkansas and I say, hey, distributor, you sell a product I really can leverage in my commerce business. I am going to buy a hat from you, and I want you to ship it to this address. And it might even be that I instruct the distributor to send it to an address with a specific person's name on it that's different than my retail business name. But the reality is that distributor is actually selling to that South Carolina retailer. They're shipping it to the South Carolina retailer in Illinois. A lot of us look at this and go, well, they're not shipping it to the South Carolina retailer in Illinois. They're shipping it to the customer in Illinois. But remember, the distributor does not have the visibility into this transaction. The only thing the distributor knows is they are making a direct sale to a South Carolina retailer and shipping it to Illinois. That's a discrete transaction for sales tax purposes. And we have to ignore what's happening between the South Carolina retailer and the Illinois customer at that level. All we can do as the distributor is say, hey, I sold to South Carolina retailer, I shipped to Illinois. I happen to be registered in Illinois for sales tax purposes as a distributor. I'm going to charge Illinois sales tax. The South Carolina retailer says, whoa, wait a minute, I'm a reseller. And in a resale capacity, I should be exempt from sales tax. I'm going to charge sales tax to my retail sale or to my customer when I'm obligated to do so. But in the meantime, I'm exempt. Well, the distributor is going to look at that South Carolina retailer and say, if you want to achieve the exemption, I need to see your Illinois resale exemption certificate. South Carolina retailer doesn't have an Illinois resale exemption certificate. The South Carolina retailer doesn't even have nexus in Illinois, doesn't have an obligation to register. Well, in this particular transaction and in this specific example for the state of Illinois, the only way this South Carolina retailer is going to avoid that sales tax is by registering for sales tax purposes in Illinois and issuing a valid resale exemption certificate to that distributor. Upon registering in Illinois, they now will have an obligation of charging tax on that sale, that hat, to that Illinois customer. So in a way, this transaction creates a scenario where a new company, a retailer located in South Carolina, has to comply with Illinois sales and use tax laws despite the fact they don't have nexus. Or the South Carolina retailer has to decide as a business, am I willing to eat the tax amount because I can't pass it on to my customer? So it's a complex transaction, and it's really complex because there's two separate transactions that are being combined into one. There's the South Carolina retailer buying from the distributor, and there's the South Carolina retailer selling to the customer. You have to look at it as two separate transactions, and then you've got to look at the laws and the requirements. I want to show you another example that it's going to look almost identical. We're only going to make one change to this drop shipment scenario. And the only change we're going to make is instead of it being an Illinois customer, we're going to call it a Utah customer. All of the other facts remain the same. We still have them going online and buying the hat. South Carolina retailers having the Arkansas distributor ship it to Utah. Here again, the Arkansas distributor has nexus in Utah, is registered for Utah sales tax purposes, and asks the South Carolina retailer for an exemption certificate for resale. South Carolina retailer says, I don't have a registration in Utah. I don't have nexus in Utah. So if we looked at the last slide, what would we assume? We would conclude that they're now going to have to get registered in Utah. Not so fast. There are some really special rules out there when it comes to drop shipments, whereby in this specific example, the South Carolina retailer can actually issue a South Carolina exemption certificate with their South Carolina registration number on it to the distributor in Arkansas in support of this transaction being exempt. It's a unique rule that Utah provides to certain types of transactions, generally drop shipments. And there's a number of states that have rules just like this. The transaction has to be structured a certain way, similar to what we're looking at and talking about today. But it's an opportunity, I will say, for those companies that aren't establishing nexus, whether it be physical or economic, to still transact business and not be incurred sales tax liability unnecessarily. The other challenge with this drop shipment scenario and the rules and the special exemptions that some of the states like Utah provide is because, again, we've got this complex transaction. Both the Arkansas distributor and the South Carolina retailer have to be educated in that rule. They have to know the rule. In the absence of one of them not knowing the rule, the distributor can deny the resale exemption certificate. The distributor can make that determination and has discretion to say, I'm not accepting your South Carolina exemption certificate. I don't believe what you're telling me. And that just seems contradictory to reality. And you're stuck. You can either pay the tax or go to another distributor. That happens a good bit. It's more common that the retailer is trying to influence the distributor in this case. And sometimes we can be successful coming alongside and trying to help and provide statutory guidance that allows our retail customer to substantiate the exemption with the Arkansas distributor. In any case, I'm going to stop here and just say drop shipments can get complicated. They already are a little bit complicated. There are different variations, so we're not covering all of them today, but just know it's a complex scenario from a sales and use tax perspective, or can be.
Yeah. And I think on the positive side, I think most of the states operate like this Utah example where a out-of-state resale certificate can be accepted. Last time I looked, there may be 9, 10, 11, 12 states that operate like Illinois, California being one of them, where the registration in the state is required. But I think for the majority are going to operate like the Utah example here, so that's good.
Here I'm going to talk a little bit about exclusions versus exemptions. I just did walk through this drop shipment scenario, and I talked about resale exemptions. So maybe I'm backing up just a tad here. Generally, when you read the statutes across all the states, it starts out fairly simple. Sales of tangible personal property and enumerated services are subject to sales tax. That's the baseline. That's the starting point. And so when we talk about enumerated services, we're just talking about listed services that the state or the legislature have decided are taxable, and they're going to be listed as such within the statutes. In the absence of being listed in the statutes as a taxable service, and if it's not tangible personal property, and let's just use our services, for example, we're an outsourced compliance and consulting firm. Our services are excluded from sales tax in Georgia. There is no statute that talks about those services being taxable. So it's excluded. And why is it important to distinguish between an exclusion and an exemption? An exclusion is statutory, meaning I don't have to prove it. I don't have to prove to you that it's not taxable or that I'm not taxable in this context. You just naturally don't charge tax on those types of services. So we naturally don't charge tax in Georgia on those services. Exemptions are basically exceptions to the rule. So if the statute says sales of tangible personal property and enumerated services are taxable, and I sell you a prosthetic leg, you would presume that that leg is taxable. It's tangible personal property. However, as we've talked about earlier, there are specific exemptions that might apply to certain types of products and services. And generally speaking, I'd say 90% of the time, there's going to have to be some level of documentation to substantiate that. So characterizing exemptions, they kind of fall in a few different categories. The most common of which is sales for resale. So everything that sits on Walmart's shelf when you walk in has not yet been subject to sales tax. Now, the shelves themselves might have been taxed, but the products that are for sale generally have not been subject to sales tax at this point. It's not until you check out and pay for that product as the end user consumer is it taxable. Now, I could walk down the street, go into the Walmart here locally. I could start a resale business. I could walk in there with my resale exemption certificate and theoretically buy something off the shelf in Walmart and not pay sales tax on it. I'm representing to them with an exemption certificate and an exemption certificate is actually just a form of an affidavit. And we're not going to get into a lot of detail with this today, but that exemption certificate is a ticket that gets me out of paying sales tax on that product. Now, I'm obligated to either charge tax when I resell that item, or if I intend to use it myself, I've got a consumer's use tax responsibility. I have to self-accrue and remit that tax directly to the state. And so it's important to operate with some level of authenticity when issuing exemption certificates. You can get in trouble, and issuing fraudulent exemption certificates can land you in jail. So we have the resale exemption certificates were the most common. That's what we'll see in the wholesale industry. We'll see it somewhat in the brick and mortar categories. There's a lot of resale certificates being managed by Home Depot. Then we get into industry exemptions. These are going to be generally more business to business transactions where we've got companies selling large scale equipment that generally isn't going to get sold to consumers. They're only going to serve businesses. That's why I differentiate the two. And in the world of manufacturing, there's really two primary types of exemptions. One, the equipment and the tools that are purchased by the manufacturer to be incorporated into the facility and used to manufacture. The second is the raw materials, the elements of what they are manufacturing, all the raw materials that go into building a car, the steel, the electrical components. Those are all bought exempt from tax as raw materials wholesale type transactions. Both of those require exemption certificates. Sometimes the exemption certificate is a different type of certificate than the resale exemption certificate. And lastly, statutory exemptions. We talked a little bit about them. They can come in the form of healthcare type items. The federal government is generally and statutorily exempt from tax, except for New Mexico. Be careful in New Mexico. But other government agencies can also be exempt. But it's not true that every state and local government is exempt from sales tax. That's a state by state determination. So even if they are exempt, they do need to issue some type of an exemption certificate to the retailer. There are such things as what we call pass-through or flow-through exemptions. If you are in the business of construction, contracting, you might be doing a project for one of these types of entities, maybe not a reseller, but a not-for-profit or governmental agency. There are scenarios where your purchases and consumption of materials that are incorporated into those contracts or into that real property could be exempt from tax. You could leverage the customer, that landowner, towards buying your raw materials. So just know that exists out there. There's just special rules around it. It's not available in every state, but a number of states do afford that.
I think Jeff had some good examples, but we engage directly with businesses and also through CPA firms that may not have a sales tax practice themselves. But we have really two different product areas or service areas in the business. One I would consider a consulting or advisory service, and Jeff really heads up that business for us. But it's helping companies really understand what their requirements are from a sales tax perspective. A lot of what we've talked about here today. And of course, as we go through that process with clients, sometimes we find that there have been some prior issues where they didn't collect sales tax and maybe should have. So there's an element of remediation and risk mitigation as part of that consulting advisory practice as well. And then we also provide a compliance outsourcing service. So when we see businesses that have a multi-state sales tax obligation, but they just lack the personnel or the time, the ability, the desire, whatever reason they don't want to do it themselves, they can hire us as an outsourced sales tax resource to manage sales tax on a go forward prospective basis for them. So appreciate that opportunity to share that with you. Couple of questions here. Is there a publication or chart that shows the drop shipment rules by state? The best resource, I think, for that is going to be through the IPT, and that's the Institute for Professionals in Taxation. And on their website, they sell a drop shipment guide. It's actually an online software product now that once you pay for it, it's a few $100s. I forget the exact costing of it, $300 or $400 to get access to that. You then have on a state-by-state basis what the rules are related to drop shipments. Sometimes they're not clearly articulated in that guide, so you have to decipher a little bit how they're responding. Basically, it was compiled by submitting a questionnaire to each of the states, and the states responded kind of free form. So it takes a little bit of interpretation, but it's still a good guide to understand what those drop shipment requirements are. Another question here, and I'll kind of tee this up for you, Jeff. Do non-U.S. entities that purchase for resale in the U.S. have to provide any type of resale exemption certificate? So I'm kind of thinking about your drop shipment scenarios, and the retailer based in South Carolina in this example maybe is based in the UK. What happens in that scenario related to drop shipment transactions and the need for the UK business to register?
Yeah, the UK business would fall right in line with that South Carolina retailer. They would have an obligation to register. And unfortunately for that business, the UK business in that Utah example, they're not going to be in a position to issue their home state exemption certificate. They're not going to have one, or theoretically, they don't have one. So, unfortunately, they're either going to have to eat the sales tax, or they're going to have to um, either get really, really creative in the transaction, which they could possibly do, or they need to get registered somewhere and be compliant and engage in sending resale exempt certificates. Thanks, everyone.
This has been It Depends, with another episode explaining the complexities surrounding sales and use tax. We'll see you next time.